Let's pick up on this now as South Africans anxiously await the South African Reserve Bank's decision on interest rates. A number of economists predicting that they will be kept unchanged. This is despite the latest consumer price inflation ticking up slightly yesterday. Well, at the previous Monetary Policy Committee meeting, a pause was decided on after an aggressive hiking cycle which began in November of 2022, and this has resulted in the repo rate now sitting at 8.25%. To help us now understand how the performance of the interest rates globally will likely influence the decisions today, I'm joined by Chifipa Mhango. He is a chief economist at the Don Consulting Group. Mr. Mhango, thank you very much for your time. So let's kick off the conversation.
Thank you for having us.
Wonderful. Thank you, sir. So let's begin the conversation with your well-considered predictions. What's likely to be announced today?
Well, I think our view is the interest rates is where it's going to stand after today's meeting.
All right. I think we've completely lost you there for a good few seconds. Let me ask you to just repeat that for us, please.
Oh, sorry about that. Okay, no, what I'm saying is that no, we're expecting the interest rates to remain unchanged based on the decision that will be made later on by the Reserve Bank. Currently, the repo rate is at 8.25%, and we're expecting that no, it will remain at that level.
All right. I'm hoping that the connection to you is going to stabilize. So why is that your outlook? Is it predicated on what we saw in the U.S. yesterday, or should we say overnight, where they kept their rates unchanged? Is it, again, back to that old adage that the U.S. sneezes and the rest of the world catches a cold, but they decided to hold on the rates, and therefore that is going to be South Africa's position, despite, Mr. Mhango, despite the slight tick-up on the inflation side, and that's a worry for the Reserve Bank.
Yeah, I think what will be the more like the guiding principle is to see where the inflation rate is in terms of the target range of the South African Reserve Bank, which is between 3 and 6%. So even though there has been a marginal increase in terms of inflation from the month of August, as data released yesterday, which came in at 4.8%, it's still within the target range of the South African Reserve Bank. In fact, even still closer to the 4.5% mid-range. So that, I think, brings a sigh of relief in terms of what will be the position of the Reserve Bank. But yes, you've indicated about the U.S. market, obviously keeping the rates unchanged. If you look at the U.S. market, the target range, the target for the U.S. Federal Reserve in terms of inflation, it's actually at 2%. And then currently the inflation in USA is around 3.7%, which tells that no, it's way above the target range in terms of the monetary policy environment in the U.S. But I think if I can also just give you a simple, some other countries. For example, in Brazil, just the last meeting, they actually cut interest rates by 50 basis points to 13.25%. If looking at countries like India, as well as China, they have kept the interest rates unchanged in the latest meeting they have had on their central banks. So guiding principles, obviously, I think would be more or less at what's happening in the other markets. So I think, as I mentioned, that in some of these markets, for example, the UK as well as the Eurozone, what you're seeing that the interest rates have been hiked on the basis that the inflation there is way above the target range of these countries, which is around 2%. For example, in the UK, inflation is sitting at 6.7%, which is above the 2% target. If you look at the Euro area, inflation is sitting at 5.2%, which is well also above the 2% target range. So that's why those countries are still trying to find ways to contain inflation to bring it to their target range of their central banks. But in the case of South Africa, I think we've got room to take a pause in terms of hiking interest rates because our inflation is still around 4.8% within the target range of the Reserve Bank of South Africa.
We're going to talk about inflation targeting in a moment and the possible impact on the economy, because that's what matters most, is it not? Let's keep the conversation perhaps around what the United States has decided, and that is indeed to keep the rates unchanged. Your predictions is that even on the domestic front, we're going to see a similar stance. However, in the U.S., they've done that, yet maintaining a hawkish stance on their policy outlook. Explain that to us in simple language. What does that mean?
What that means that the environment in terms of inflation projection remains a bit volatile, in the sense that there's still movements around the energy prices. There's still also concern around food prices in the U.S. market. So those key contributors towards the inflation are still on the higher side in terms of the volatile environment in the U.S. market. So much as the inflation is cited down to 3.7%, as I mentioned, it is way above the target range of the 2% in the U.S. market. So it's still an area where the central banks in the U.S. will actually be monitoring in terms of how the inflation outlook is actually appearing. But I think the risk towards a higher level in interest of inflation in the U.S. market is more hindered around energy prices, food prices movement that are actually still posing a threat in terms of the inflation outlook in the U.S. So that's where they are saying that they will be continuing to monitor that. And I think the possibility of even a hike in interest rates in the U.S. market in the next meeting are highly likely based on the way they are looking at inflation projection in the next coming months.
All right. So let's get on to that other question I signaled earlier. Inflation targeting. That's a long-standing debate in South Africa. I'm going to put it, I'm going to crouch in that way. It's a debate, even though that debate sometimes it does tend to get quite emotive at times, because this inflation targeting is a sore point for unions who have their members in the employ in the various sectors of the economy. So inflation targeting versus economic growth. Why is this such a tough balancing act?
I think it is a balancing act in the sense that you see, if you look at how the policy environments occurs, in fact, if I can just give you a simple perspective, I did write an article around the inflation targeting policy in 2002, in a way trying to give a view on the basis that we cannot only be focusing on inflation alone, but I think also looking at other parameters of the economy in terms of what will be the impact in the case of interest rates hike or interest rate cuts on the economy. So I think from that perspective, you look at there's some factors where whenever there is a high interest rate, for instance, it also discourages investment in an economy from the point of view of lending, which actually disrupts lending activities in the economy. So that can have an effect towards employment in some sectors of the economy. For example, the vehicle industry. The vehicle industry in South Africa, from the production side as well as sales, is heavily reliant on the credit market. So if you have high interest rates, in the case like what we've been seeing, where the interest rates have actually been rising in South Africa, that also depressed sales in the vehicle industry. So which means that the production might be limited on the basis that there is no sales in the vehicle industry. So that can also discourage employment. So there is always that kind of a relationship in the economy between interest rates, also the credit lending. I think, but what we have observed in the recent years is that the South African Reserve Bank, much as they are talking about inflation targeting, but if you look at their statements, they all bring in the element of growth in the economy. They are also bringing element of employment in the economy. So that position gives you a perspective that the South African Reserve Bank is also taking into consideration other factors at play in the economy with regard to the interest rate decision.
Yeah. Final question to you, sir. The connection does seem to be losing us. So let me pose this final question to you. When we look at the employment situation in the country, and I take that outside of South Africa and look at the world globally now, we have what is worrying many people around the world, and that is the cost of living crisis. Inflation talks to the price of goods and services. You combine these two, we have a serious situation in our hands, and then you have our national treasury talking about cutting back on unnecessary spending, and they're under pressure right now because there does seem to be jobs on the line as well. Where am I getting at with this question? Should we have reason to worry about how our economy is managed domestically, but by extension, look at how the world economy is managed and whether or not we are going to see these uprisings that I think were warned about when we were going to, I think it was the World Economic Forum earlier in the year?
I think you're breaking up, but if I can just share with you in terms of what's been happening on the domestic front. You know, you mentioned about the Treasury. I think the Treasury Department they have done their part in terms of supporting the element of growth in the economy. For example, we've seen a lot of share being provided towards infrastructure spending, which I think is one of the stimulants for growth in the economy. But I think the biggest problem we have had is that that expenditure in terms of infrastructure, it's more in terms of lack of implementation of that infrastructure investment in the economy. Most time the national budget, they actually allocate a lot of, in terms of what's happening in the economy. You're seeing that no, the level of fixed investment to the GDP of the South African economy is still below 20%. Why, if you look at other major economies where there's high potential for growth in the economy, you see that no, fixed investment to GDP ratio is about 40%, or even reaching about up to 50%. Policy implementation, when we say these are the projects we want to implement in terms of infrastructure, road infrastructure, railway infrastructure, and so on.
Ouch. All right. Mr. Mhango, let me apologize to you, sir. It is difficult to have a thoroughgoing conversation because of the intermittent connection. Unfortunately, we must cut the conversation short. Chief Economist at the Dawn Consulting Group, Chifipa Mhango, I apologize for having to end that conversation without concluding properly the question that I posed to him in the latter part of the conversation.